to a really great financial future. Tom and Don are talking real money.
Here is an interesting quote that will make sense as we move a little farther into today's exciting edition of the Talking Real Money podcast. Here you go. Just let this sit with you for a moment. Just let it sit. Quote, "It's rare that the stock market leaves free money lying around." Unquote. Think about that for a minute while I introduce your two exciting hosts of your exciting program. I'm Don McDonald, holding down the Florida fort. That's Tom Cock, waiting for the sun to come out, still in Washington State or the Seattle area.
Okay, you want an illustration of that?
Yeah.
You're going to really laugh. So every week now I check the temperature in my little lake, that I live on.
Yeah, you live on a little lake.
I made a pledge to get in it in May, which is,
Well, it's May.
I know. As my daughter pointed out, well, that could be May 31st. Yeah, it very well may be.
Yeah.
For May, that's no pun intended. But the thing is, I checked the temperature a week ago. It was 68. I checked the temperature yesterday, 65. I mean, we're going the wrong direction here. So
yeah,
this is the lake temperature. It's kind of cold.
Just to put that in perspective, when Debbie and I want to go visit and play in water, we don't go to some lake because Florida's lakes are full of alligators and amoebas. We go to a little place called Typhoon Lagoon down the street. Little
that
Disney
sounds kind
water
of violent,
park.
Typhoon Lagoon.
It's a themed thing.
Okay.
Anyway, it's a great water park. It's really a great water park.
I believe that's bathing water.
What's the water temperature at
80
Typhoon
probably.
Lagoon? 82 degrees.
Yeah,
that's where they keep it.
A bath.
82 degrees. Well, okay, a bath only for people who think that they can get into 68-degree water.
Which I may well be getting in here in the next couple of weeks. We'll see.
Crazy, man. Yeah. No, what are we talking about today? We're talking about what people believe is magic money. A lot of pundits and experts and media are out there recommending that you, particularly you in retirement, go for a really wonderful source of income in retirement, and those are called dividends. Buy dividend-producing stocks, and you'll be set for life because you know how safe these dividends are. These companies have been paying dividends for decades and decades and decades, but a lot is missed in that advice, and we want to expose all of the holes in what we believe is really, really bad investing advice, Tom.
Yeah, and remember, when you're getting a dividend, you're getting a profit. This is money the company has earned, right?
Well, hold on. I was going to say, you hope you're getting a profit, but some companies don't have a profit and pay dividends.
I know.
For a while, anyway.
Paying them out. But the company could also do what with that money? They could spend it on the company. And in many cases, you read some of these stories, they probably should. But overall, it's an interesting time for dividends because I think I heard you mention recently on your Friday call-in show that the yield has traditionally been somewhere between, I think, 2.5%, right? But
traditionally, yeah.
Right.
It's because of all the people chasing dividend yields. You see, if demand exceeds supply, which it does right now, the yields get pushed down. And where are they these days?
And the S&P 500 now, right around 1%. So it's a pretty small number. But that doesn't stop so many fund managers, so many investors from thinking they can find the free lunch. In the first quarter, $22 billion, the highest amount in 4 years, was poured into high dividend-paying exchange-traded funds that pay out 5, 6, a lot of money, right? More than what you could get certainly with safe money in a treasury investment.
In a savings account or something.
Exactly, or something like that. So these are funds, again, where people believe they're getting something for nothing. That's been the problem I have with them. But listen to some of the companies. These are good companies, right? General Mills, UPS, Best Buy, Kraft Heinz.
Those are
Whirlpool.
all the kind of, they're considered safe dividend payers.
Exactly. Whirlpool, we'll get to that in just a minute. Big dividends, big money. So how should people look at high dividend paying funds. I mean, this is the part that we all forget, I think.
Yeah, because we're all caught up in that income stream that we forget the biggest part of stock market returns is growth. The value, the increase in value of these companies. That's why a lot of companies don't pay dividends. They put it back into the company to invest in growing the company. Apple, for many years, didn't pay a dividend. It's still a very small one. NVIDIA pays a teeny tiny dividend.
Tiny.
And here's where the disconnect lies. And this is from an article by Spencer Jacob in the Wall Street Journal recently.
Someone
Let's
we
look
think
at some
you
of
should
these,
read. Yeah, he's good. Yeah.
Let's look at some of these big dividend payers. Big ones. Like, let's go. Let's look at Campbell's. I mean, what could be better than soup? Soup is a money-making machine, right? Pays a nice dividend. Over the past 10 years, you would have made negative 54% on Campbell Soup.
The stock, the price.
The stock. You would have lost half of your money over the past 10 years. How about Kraft Heinz? Very similar. They got your ketchup. They got your cheese. They got all that stuff you eat. It's a defensive stock. It's got great potential, right? Last 10 years, negative 57%. By the way, what has the S&P 500 done over that same period?
That was fun part of the article. Only 324%.
Right.
With 500
irrespective
companies.
of the dividend strategy.
Yeah, which they point out, by the way, a decade ago at a yield of 2.1, as I say, now it's closer to 1. And yet this goes on. People believe they're free money. They forget that the value of the company goes down. I think there's nothing more illustrative, interestingly enough, that in the same day in the Wall Street Journal that Spencer wrote about this, the cash cow that had been paying out dividends since 1955, I think it was, something like that. Whirlpool.
Yeah. It was a money-making machine back in the day.
Yeah.
They made Kenmore, which we've talked about on past episodes.
Yeah, exactly. They have decided to pull the plug on their dividend. Last year, they paid out $300 million, even though their sales are down 6%, even though their market share continues to erode thanks to great companies in South Korea, for example. And last year, they also, to sort of keep the lights on, and I hope still shocks me, they decided to sell another $1.1 billion worth of shares, sort of to buoy the company. How you can take that in the front door and hand it out the back door, I'm not an accountant, but it doesn't sound like a good practice in general.
No. And if you look at their balance sheet, you'll see they've been paying out these third of $1 billion a year in dividends, and they borrow money. Borrow money to pay dividends?
Yeah, it doesn't for me pass the smell test. So, okay, but what?
Well, it seems like
bad
math.
Yeah, how is all this? What does all this meant? Because the article correctly points out, really, basically the entire article in these 6 words, and total return is what matters. What matters is how much you made on your money. Now, you pointed out some of these shocking, frankly, losses for 10 years. Half your money, 10 years. That's a long time to be underwater. But how is a dividend-paying strategy, for example, in a fund, mutual fund or exchange-traded fund, done compared to just owning, I don't know, an index, for example?
Well, I looked at the Vanguard Dividend Growth Fund, and over the past 5 years, the Vanguard Dividend Growth Fund has returned total return of 6% per year. The underlying index, which I believe is the S&P, 13% over that same period per year. So more than double just by owning the index. And your risk is not dramatically reduced when you own a dividend-paying fund. It's a little lower. Your standard deviation, because it's buoyed, the volatility is buoyed a little bit by those higher dividends, is like 11, where it's 13 for the index, but your returns are dramatically lower, and they're not safe. Remember, dividend funds aren't safe like a bond fund.
It's not income like that. No.
Yeah.
Mm-mm. Yeah. No way.
And there's no guarantee from by the company With a corporate bond, you have a full faith and credit. Usually, you have a full faith and credit guarantee by that company that you're going to be first or second in line as a creditor.
Yeah, and I think Whirlpool is a great example of how bad it can be to go from $300 million one year to zero the next, and to see all these things that have happened to them. So, again, a couple things in my mind, always true. First of all, yield really is, and this is from somebody else that I read a lot, yield is for farmers. They're the ones that need to determine how much they're going to make on their crop yield. That's one thing. Number two.
Are you making an old McDonald joke?
And it's funny. I'm the farmer, and anyway. There is no free lunch. You just said it right. There's no dollars to be scooped up on Wall Street that nobody else is paying attention to. That's what people think. It's easy.
Sure.
No knows
Hundreds
about
of millions of people worldwide invest, and they didn't notice that money laying on the ground. Yeah, you think?
You go ahead and grab it. I mean,
You're
here's the other
delusional
part.
if you think that.
When you limit the types of stocks you own, and when you buy high yield or high dividend payers, you are reducing your diversification dramatically.
Well, here, let me give you an example. You ready? The Vanguard Dividend Growth Fund?
How many?
51 stocks.
Yeah, I mean, versus
the S&P 500 is 500.
Right, and you know that we're going to tell you to own 10,000 stocks. Mm-hmm. And if you do that, guess what? Dr. Bessenbinder is going to remind you, will this include the 4% that have done better than T-bills? Maybe, maybe not. So you really don't. This is not a good strategy. It's a panacea. I think you used the word when we were discussing this, that people believe really will play out for them and work, but I don't think it will in the long haul. No.
Well, and plus, here's the thing. A lot of the folks who talk about money, who give advice, they're always looking for a gimmick, for something that sets their advice apart. And so it's enticing to think, well, I can make more than that lousy little 1% that the S&P 500 makes in income. I can get bigger checks every month if I go for that 5 or 6 or 7% high dividend paying fund. But remember, and by the way, with some of these high dividend paying funds, some of that money is yours just coming back to you. It's not income. It's just a return of your principal. So there's no strategy that's magical. And anytime anybody anywhere is pitching you on one, you can pretty much count on it being wrong. I'm not going to say lying, but wrong. Questions? Hopefully we have answers. If not, we're going to try really hard and get them. But we have a lot of answers because we've been doing this for a very long time. You can just simply go to talkingrealmoney.com. I know all of you have some sort of an internet device. You do. Even if it's just that little annoying phone thing in your hand, it can get on the internet. Go to talkingrealmoney.com. Look for a button that says contact us or ask a question, and then either type your question or speak your question. If you type your question, we're going to answer it on one of these shows or maybe even in a phone call with, oh, look, Tom's taking another call right now.
And so we go to the phones. Let's talk to, and this is a great name. I love this. Davy in the Navy. All right, all the ships at sea, they've come in and they're calling us. Davy, how are you today?
I'm doing great, Tom. Thanks for taking my call today.
My pleasure. How can we help you?
Well, I'm coming up on retirement. I've got 33 and a half. I'll have 33 and a half years of active duty service when I retire in about 2.5 years. I have a guaranteed pension that's going to be COLA adjusted at about $10,600 a month, and then possibly some VA disability on top of that, which potentially another $4,000 a month. We're pretty heavy in our retirement between TSP, Roth IRAs, about 700,000 there. And I'm trying to figure out what to do as I get closer. Having this guaranteed pension and income, should I still keep putting money into retirement or work on paying off the house?
Wow, it's a great question. What's the mortgage on the house?
We still owe about $395 at 5.25%.
You know, that 5.2, that's an interesting number because generally anything over 5, I'm going to say pay it down. But let's just very quickly just go the pension, fantastic. And so do you expect the pension and or disability to cover your day-to-day expenses?
Yes.
Okay.
We should have 100% coverage just off of those two payments.
Okay. And then when you look at your overall savings, how much on a percentage basis would you say is sort of in the, qualified, like an IRA, traditional IRA or 403B, whatever it is? How much is in Roth and how much is in brokerage? Can you kind of break it down fairly simply
Okay.
that way?
Yeah. So between TSP, which is our thrift savings plan, Roth IRA, there's 700,000 there between mine and my wife's. And then I also have an additional brokerage account for about 170K on top of that.
So you're a little lighter on the sort of what I would call after tax money, the brokerage money.
Correct.
Yeah. So this is, due to the fact that you're going to have all that guaranteed income and the fact that, by the way, the other money, the traditional that you've saved will continue to grow. You won't have to take that out until you're age 75. That's a long time from now for you.
Right.
I don't know that I would be adding in any more in the traditional. I might be trying to load up on the Roth and or the brokerage if you had, sort of money to save. The only question then I might have is, what's your tax rate? It should be relatively low working in the military, correct? So, I mean, you're not facing a huge tax, break by sort of taking money and putting it into the traditional. So I might turn the knob up a little bit on the Roth and turn the knob up on the brokerage. In terms of paying off the house, whether you take some money and you throw it at that. This is always a very difficult question because emotionally we all say, well, I would like to live in a house paid off. I feel that way sometimes too. And then I look at my payment and it's not that big. And the interest rate, mine's a little higher than yours. I don't love it, but it's not going to kill me one way or another. So, I might say do the Roth, do the brokerage, and then maybe put a little bit more towards the house. Again, I don't know that I'd be telling you have to pay off that mortgage, that has to get done prior to retirement. But those might be the order in which I set money aside for the next few years. And man, I'd be also recommending that you figure out, because I know the way, having a father who is in the armed forces, you figure out what you're going to do when you leave the employment of the U.S. government. Plan some trips, do some fun things. You're young. You should get out and enjoy some of that money as well. So that's another reason to have money in brokerage, because it's easier to access at generally a lower tax rate.
Yeah, that makes a lot of sense.
I would probably do something like that. I mean, the other thing that might be worth considering in your situation would be kind of what the asset allocation is. In other words, how much in riskier stocks and how much in bonds, because you have that bond-like pension, right, that's going to pay you all the time, that's going to make up such a large portion of your income. Maybe you then, not knowing your personality, but you tilt a little more heavy into the stocks, riskier stuff there, hope to get some growth. And as I said, you're going to have another 20 years of growth, tax deferred, which is going to be awesome. And maybe even at some point you consider some conversions. I wouldn't worry about that today, but I'd probably try and stock up on that Roth, boost that post-tax savings a bit, and then maybe throw a couple bucks at the house. But I wouldn't get overly worried about that unless it really is an emotional thing, like I just want to have this paid off. Then maybe you could come up with a strategy to put some of the extra money towards that and sort of clean that up.
Yeah, that sounds great. Yeah, most of our funds that we currently have, we're 100% invested in equities. And actually, before I started listening to your show, I was 100% in like VTSAX or VTI. But after listening to you guys, I've really started getting into a little more into the international funds and expanding my horizon a little bit more into the VT or VXUS EFTs now.
Good. I mean, and that's, again, we don't favor other countries over the United States. We're big fans of the United States. It's been good to us, and to you as well. But
job security.
Yeah, it's exactly. But the thing is, having that balance has meant a little more return and a little less volatility. Certainly the last year and a half has been dramatic, right? Internationals have way outperformed, especially emerging markets, the U.S. market. So you just want to make sure your money's positioned there for whatever's coming along. Balance that out. You're doing a lot of things right, Davey. And again, thank you for thank you for listening to the show, but thank you for your service, which is unbelievable and exemplary.
Well, thank you very much. I appreciate you taking my call.
Take care.
Nice call. There you go. Good job. Thanks for doing that. Look at you. You and Tom had a nice chat. That was lovely. But you can also just, if your question's a little shorter, it doesn't need all that banter. It doesn't need all that conversation. You can just type it up, and Tom will pick up a piece of paper. For some reason, he can't look at it on a screen. I'm not sure why. Even with my book, I had to send it to him in paper.
In
a paperback version.
Yeah.
Because he didn't want to read the e-book.
I'm pretty close to having everything now on Kindle, but not everything.
Can I plug? I just came up with something really cool.
I really preferred that you don't cross this line, but okay, go ahead.
Oh, the book is called The Line Uncrossed.
Ah, that's it. Okay.
No, I came up with a great idea. Because around the book, The Line Uncrossed, which is the fictional story kind of loosely based on my great-great-grandfather. Yeah. It's more fiction than fact. It's a Civil War story about a young man, very young man, true story, who enlisted in the Union Army as a teenager.
Wow.
And fought in various battles and, anyway, had a bad bout of things when he got captured at Chickamauga. So I wrote also a couple of short stories that I'm doing on lit reading around that from the Line Uncrossed universe, 2 other short stories. And I also found a lovely old story written by a Union officer who became a writer, a very famous writer, Ambrose Bierce. And he wrote a story called Chickamauga, which is about the Battle of Chickamauga. Great story. So what I've done is I've created an ebook to accompany the ebook of The Line Uncrossed. And you can get both of those for the price of the ebook. And I'm going to try and put them out early. They should be out before the 22nd. And you can buy those for just $5 at donmcdonald.com.
Wow.
Just
I'm loving the uncrossed line, the line uncrossed.
That's an EPUB or a PDF edition along with the bonus of the short stories, too.
The picture on the cover, remarkable shot of your great-grandfather. It's very cool.
Yeah, that was taken with a drone.
Wow.
Those early 1860s drones, yeah.
Funny guy. All right,
It was a steam-powered drone.
Yeah. All kidding aside, it's very well written, and it's a great story. Ricardo writes us from Alhambra, California, which is important to me because that is the city of my father's birth.
Oh.
Beautiful Southern California. Don and Tom, thank you for your show and the service you provide. I've learned much listening to both of you. I'm an employee of the University of California, which has its own retirement plan, UCRP. You can invest in-house using UC funds found here. Yeah, exactly. Or, here's the crux of the question, or through Fidelity brokerage account where you have access to many choices. I've learned from your show to be diversified as an investor, to be the market, not beat it, as you both continuously state. I'd like to know your thoughts if it makes sense to invest the 403B in an ETF like an AVGE or DFAW through Fidelity, or in the UC Global Equity Index Fund, which is very inexpensive, by the way, tracks the performance of the MSCI IM. It's an international X, in this case, X fossil fuels and tobacco, which worries me a bit.
Well, that's because it's UC, dude.
Right. It's also learned about having small cap value, which I cannot determine if the UC fund has compared to the ETFs. I'll just tell you right now,
the answer to
that is no. But the gross operating expense ratio for the UC fund is 0.01. We know the expense ratio for the AVGE, very low, 0.23, et cetera. It makes the question at hand is, should he use that very low cost index fund available through the UC plan, or should he go through the brokerage account and use one of the aforementioned global funds, AVGE or DFAW? Oh, you're clapping? You're ready to go. Okay,
I have such a great answer to this one.
I'm so happy. Please.
For the bulk of your international, use the cheap fund for the bulk. And then add maybe 20% of the equity portfolio, 10% in small cap value.
So an AVUV, for
like an AVUV.
Yeah. Okay.
Wouldn't that take care of the problem?
80% in the UC fund, which is very cheap, sounds diversified, I don't really like that they're selecting out fossil fuels and tobacco, but I guess that's okay.
They're gonna go ESG. You know that. It's the University of California system. You know they're gonna go ESG.
Yeah.
But wait a minute. Doesn't Avant that the AVUV is only U.S. though?
That's correct.
How about adding? Oh wait. How about 10% U.S. small cap value?
That would be AVUV.
And then even better.
And then 10%
Hold on.
AV.
I got a better plan. 10% AVUV, about 6 or 7% AVDE, which is their international equity fund. It's going to have a small value tilt.
Yep.
And then the rest in AVEM.
That's their emerging markets.
Yep.
Okay.
Yep. I built the portfolio just like that. Look at that.
Beautiful. Ricardo, thank you for the question. David from Fort Myers, Florida writes, I started listening to Dawn in Erie, Pennsylvania on AM radio in the late 90s.
WPSE.
Now I'm assuming this is the 1990s?
It better have been. Yeah, the 1890s, we hadn't invented radio stations yet.
Okay. He says he was in his late 20s. Mm-hmm. Retired at 59, never made over 100,000, now worth $2.5 million with no debt. Simple S&P 500 investment and some smart moves. Thanks again. Don't know if you were still around. Just want to say thank you.
I'm still around. By the way, funny story. When I was fired by Business Radio Network in 1993, my wife got on the phone. My wife and the staff of our newsletter got on the phone, and they started calling the 90 stations.
I was on the list.
Yeah, you were on the list. They started calling the 90 stations that carried the Don McDonald show.
That's right.
And 89 of them decided to break their BRN contracts and flip the switch over to Disney's satellite channel when I was doing my show at Disney World. And only one was afraid to switch.
I'm surprised you're not mad at me for being the one not to switch.
No, it was WPSE in Erie.
Oh, interesting.
Because they were part of the University of Pennsylvania.
They didn't want any trouble.
They didn't want any trouble.
Yeah, okay.
Whereas Ron Cohen went, let them sue me.
Yeah, I remember switched it. I don't think they ever knew. They run around and listen to everybody.
But it was so funny because that was right at the beginning of paid financial programming.
They put on hints from Heloise or something, right?
They put on a paid program by a guy out of Kansas City. He bought my slot, and they were paying me a salary, a 6-figure salary, for doing the show. And he bought my slot, and he went on the air with one station.
Probably not really successful show. That's why he's.
It went away really quickly.
Not doing the show today, and you are.
Yeah.
All right, one more question.
Keith DeGreen. That was his name. Keith DeGreen.
That's right.
I remember that.
Probably still on KFNN in Phoenix. Oh, sorry. Rob writes us.
They went under.
Yeah. Rob writes us, when it comes to scheduled withdrawals from my retirement account, which is 60/40 equity bond should be scheduled to pull from across the portfolio. In other words, if you have a 60/40 and you're doing withdrawals, should you pull from the bond? How does this all work? Where do you take the money from in withdrawals from a balanced portfolio like 60/40?
Oh, well, first, the place you start is with your rebalancing. That's the magical way to do it.
Okay, describe what that is.
Well, for example, let's say you've had a good year with the stock market like this year, and your 60/40 is now 65/35.
More than that, actually, but okay.
Well, okay, but I'm just, this is
so
hypothetical.
Now it's overweight stocks. You're 65% in stocks.
Which gives you, if you sell off the overweighted stocks.
And I know the feeling.
You're going to get yourself, just by selling off the stocks and taking that money in cash, you're going to get yourself back to a 60/40. You just take out enough to get you back to a 60/40. That cash you just took out, that's the first money you draw from.
Yeah.
The second money you draw from is the dividends. You just stop reinvesting some of the dividends. Third.
But again, the better approach long term is a total return approach. Let the dividends.
Right. I'm just saying, if you want to. Well, yeah, but where are you going to take it in that total return approach? It's a total return approach. That would be the
rebalancing.
The rebalancing primarily, but if you need a little more over and above that, then you just start taking some of those dividends. But that's still part of the total return approach.
Yeah. Okay. All right.
And then you take them out. You take it out from your taxable account first. Then you take it out from your deferred accounts. qualified IRAs and
Traditional.
401ks, and you leave the Roth away alone forever.
Yeah. That's good.
Forever and
good
ever.
advice.
Do you know that Keith DeGreen has a podcast?
He's still on the air, huh?
I don't know if it's still new. No, it hasn't. He hasn't done it since 2023.
Okay. So
It was called As I SEA It. I don't know what that means. Oh, I guess he's on a boat.
as
Yeah.
I see it.
See it. Yeah.
Okay. Great question, Rob. That comes up a lot, by the way. That's a reason sometimes to talk to an advisor, because that's exactly the kind of thing a good advisor is going to do. Not just portfolio construction, not just great planning, not all the work they should be doing, but the generation of cash. It's part of the toughest thing for many people in retirement, the most tax-efficient manner in which to do it, the one that's going to have your portfolio sustain itself for the longest. That seems to me the biggest stumbling block for most people as they approach retirement.
Yeah, it's really important for those who've really built up a decent-sized nest egg to at the very least, sit down with a planner who doesn't sell product, someone who can write a plan and at least pay for the plan, even if you don't hire an advisor. At least pay for a plan. Okay?
Yep.
Where does Keith live now? Oh, he lives in Arizona. He lives in
Lot of
Scottsdale.
sea- lot of
Isn't there
seas.
a big surprise that there?
There's a lot of sailing in Arizona, as you know. So
Yeah. Well, or
Salt
at least
and
he
sea.
did on his LinkedIn profile. I don't know what any of this means.
I think it's time, in the words of a very famous Disney movie, for you to
Let it go?
Yeah, I think so.
I was just curious.
Okay.
I was curious. He's an RIA in Arizona.
Oh, okay. I wonder what he's selling.
You know, that's for another. I think I'm going to look it up for a future episode. I'm
bet
going to do
you
some.
are.
I am. I'm going to do it in a future episode.
Let's send him to Andersonville. What do you say? Huh?
No. Oh man, no. Ooh, after doing I went to Andersonville about 20 years ago. I was driving to Atlanta for something, and I saw the sign, and I went, "Oh gosh!" And I had my great-great-grandfather's letter with me for some reason, or it was on a phone or something. And I went to Andersonville, and I walked around, and I read his letter, which I can't find now, and I was moved. I was teary. It was, man.
Is it
So
in the
that's
book?
why one of the reasons Andersonville's definitely in the book.
No, the letter.
No, letter's not in the book because I can't find the letter. I asked my sister. She thinks she has it somewhere. So,
Well, then
but no,
we'll
the
blame
letter's in
her.
the book.
Her or Keith, whichever
Don't blame
one you
me.
like. Okay.
Keith will be fine. Send your questions in. TalkingRealMoney.com is the place to do it. If you want to meet with one of these fiduciary advisor people we have at our company, Alpello Wealth, you can do it for nothing. Really. I know everybody says, complimentary consultation. Well, no.
Everybody offers that.
Everybody offers that. This is not that. Well, it's complimentary, and I guess if you want, you can call it a consultation. But here's what it isn't. It isn't what 95%, 99% of the others are, which is not really informational. It's sensational.
Well, they
It's
want to find
sick.
out what you've got, and then they're going to pitch you on why what they've got is better.
Right. We'll make you more money. We have magic tricks. We have good stuff. Yeah.
Always.
And they anyway. We're not going to do that. We're not going to put the full court press on you. We just don't believe in doing that because we don't need to.
Oh, I'm too old. I only do a half court press at this point. So
You don't even do a quarter court press anymore.
the only last thing I pressed was a shirt. So,
Although I can't believe you're still farming, Mr. Green Jeans.
oh boy, this is going to be a big year for the garden, especially since we put up the netting to keep the deer out. So
I understand that the Seattle area has above average intelligence deer, so they're going to figure out a way
About to
through that
find
netting.
out.
Yeah. All right, thank you all for being there. Please tell a friend or maybe a dozen, and and keep pushing us up there to pass stacking Benjamins
you
like we
just can't
recently
live that
did.
down, can you?
We did.
Yeah. Wow.
We did it. I know you don't listen, Joe Saul C. High.
But we're coming for you. Is that
But
right?
we're
He's
coming
shaking?
for you, dude. All right, thanks for listening. I'm Don. That's Tom. We're talking real money.
The opinions and views expressed on this podcast were current on the date recorded.
Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone.
This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction.
Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.